Wealth Without Wall Street Tribe. Excited to introduce you to Jim Manning today. Jim, welcome to the show.
Thanks for having me. I really do appreciate it. How you doing?
We're great. Passive Wealth Show. That's the podcast that you guys run. I want to build passive income. I guess that leads to passive wealth. Tell me specifically, what is the niche? What's the area you guys have become an expert in?
Yeah, so we do single family real estate investing. And the two favorite ways that we like to generate the passive income are called lease purchase deals and then private lending. And both of them have been incredibly powerful. We've seen, over $10 million in passive income the last 2 years alone in our group of partners. And it's been a wild ride, but happy to be here. And by the way, guys, Wealth Without Wall Street, the mission that you guys have, the following that you guys have, I absolutely love it. Could not believe in it more and how important it is. And I've been excited ever since we decided we were going to do this. So thanks for having me on. And I totally get why you guys listening in follow these two guys, right? Joey and Russ. I mean, it's awesome. So thank you.
Well, man, Jim, flattery will get you everywhere with us, by the way. It's
right.
So good. All right. So 10 million in the last couple of years. That's not bad. Is that good? Is that good? I don't think it's probably good.
Yeah.
All right. So I understand private lending, or I think most of us understand private lending or can get our heads around that. But maybe lease purchase is a term that hasn't maybe percolated as well in our brains. Help me understand what a lease purchase is and why should I learn about it?
So lease purchase, rent to own is another term that people will use. Technically, we like to do the lease purchase model better. I can kind of get into those differences in a second, but I fell in love with the model because we had started out, back in 2017, we had built our flipping business up to 250 at the same time. And, we've done thousands of deals over the years. And what I like about flips is there's a little bit of influx of cash. Like maybe you make $30, $40, $50, $100,000 on a deal. And that's nice to get that up front. But the downside of that is that you're not building any passive wealth. You're really only as good as your last deal. And where the lease purchase comes in and why it can be so powerful is there's an influx of cash. A tenant may give you 5% or 10% down on a property before they move in. And that down payment money is not taxable until they buy you out of the property and execute on their lease purchase or end up moving out of the property. So you get that influx of cash, kind of like a little bit of flip income, but then you also get monthly cash flows on it on the back end too. And we like to do lease purchases over rent to owns because we want to be the lender on the deal and put the tenant in the place of in more of a position of a homeowner. So if a toilet leaks and you own a house, you're the one calling a plumber. You're not calling Chase Mortgage, right? If Chase has the lien on the property. And so by operating this way, what we've been able to do is create higher cash flow with lower overhead than what a normal landlord takes on. And so we have, as about 30 in our most recent fund that's closing down. There's about $37.5 million in properties in the fund. And I just was calculating this the other day, like our normal repairs and maintenance budget, if we were doing a traditional landlord, would have been about $350,000 on these properties. We only got hit with about $50,000. In repairs and maintenance. So it doesn't eliminate that cost, but it substantially lowers it. And that's one of the worst things about being a landlord is you buy these buildings for passive income.
Yeah.
And then what happens? The roof's leaking. Now I need a roof. Gosh, that's 3 years worth of income down the drain. So
yes.
Yeah. So anyway, we've fallen in love with the model so much that we were doing all of these flips and we shifted not all of our business, but a lot of our business into doing these lease purchase deals.
What's the most important resource that you have? If you really thought about this deeply, I think you'd come to the same conclusion that Joey and I did. It's time. In our newest book, Wealth Without Wall Street, The 3 Steps to Financial Freedom Through Passive Income, we talk about how are we tracking that time? What is the thing that we can do to get more of that time back.
That's right. If you've ever been listening to our podcast and thought, man, it would be amazing if I could take all the things that you guys have learned over the last 10 years and just summarize them, put them in some way to easily digest them and take action, that's what this book is all about. You're not going to want to miss it. Go to wealthwithoutwallstreet.com/new book and get your copy today.
So Jim, I know Russ is going to ask me after the show, so just rather ask you in person instead of, just having to try to do this behind the doors.
You said rent to own versus lease purchase. In my mind, both of those specifically talk about that the person on the other end is leasing from you, but because it has a purchase attached to it, talk about how that puts them as an owner, even though there's technically not a transfer of deed at that point, correct?
Yeah, it's an owner by contract scenario. And so you're still getting, as the investor owner of it, you're still getting the property depreciation as well. But by doing it that way, like the agreement and the paperwork that we draw up is, hey, you're responsible for the repairs and maintenance. Like, we want these people to be homeowners, and we want them to act like they're homeowners, not act like they're tenants. So we can reduce that risk profile and we can get them to do everything, or we can get them to do those repairs and maintenance. If we just tell them, hey, you're in our rent to own program, well, what message are they hearing? Well, I'm a tenant.
And I'm a renter. But also in the commercial space, we run businesses and some of us don't own the buildings. We just lease. We kind of think of ourselves as renters, but yet the difference is, I guess, we know we're responsible for everything inside the building typically. And then it's whatever the external part of the building, the yard, that kind of stuff is typically owned and managed by the landlord. How does that work in a single family rental property? Are you guys maintaining the yard and the roof or the exterior things, or are they responsible for everything?
So, this is my understanding of it, is it's really just about how you negotiate the deal and what your paperwork says. And so in our case, how we like to do it is it's more of a homeowner lender relationship. They're responsible for everything. Now, we pass through the insurance and the taxes. We pay for it. We charge them that. So we want control over that. That's just kind of important, right? That's a potential risk factor in the deal. So we're the ones striking the policy on that. But yeah, that's the agreement that we do it in. And depending on what state you're in, I'm not an expert in Texas. I think Texas needs to be more of a contract for deed. That's what I hear. I have a friend named John Jackson that does these deals out there, and I believe that's what he's told me, how he does those deals. But in Missouri and Illinois, we call them lease purchase deals, and that's how we're able to set them up.
Up to this point, how many have you guys done?
So we've done, in the last 2 years, it's been over 400. And Jason brought these to us. He started out doing them in 2014, and he's done over 1,000 now.
Oh wow! So
he's one of our partners. Yeah.
So you guys have figured out this is how it works. So ultimately, let's kind of break down if I was going to do a lease purchase on my own, or if I just wanted to invest in it. I think that's typically our audience. We have a little bit of both, right? We have some people that listen. They want to find an idea and see if they can go do it themselves because they're kind of DIYers. And then we have some that are like, I make enough money doing what I'm doing. And I like doing that. I would just rather spend time doing that, making lots of money, and then investing in things that I think are interesting to me and my investor DNA profile. So
That's right.
Talk about what goes into a lease purchase. What do I need to know about it, both as an investor or someone who wanted to potentially do one?
There's a contract side of things. You really need to make sure that you have consult with the right attorney if you're going to DIY it, get them set up the right way. And then there's the marketing component of it. You have to be able to find these tenant buyers. And when we started working on them, this was the third company that I founded. And I thought, oh, well, this isn't going to be that big of a deal to develop out so we can scale it. The first couple deals we did, the demand we got was absolutely crazy. But scaling it ended up being, took us a couple of years to get the organization set up the way we needed to. So one of the harder lifts that we've ever done in business. So if you just have like one property, you can get away with it a little bit. But when you're talking about doing 20, 30, 40, 50 at a time, getting the right team members in place, the right systems, the right paperwork, all that lined up. I mean, that's definitely one of the pain points to pulling this thing off. But, so let's say you develop all the marketing systems out, just good old fashioned tenant screening goes into it too. Making sure that you have the right underwriting and you get the right person in there. In our niche, like we're doing middle-class neighborhoods that we really like. And these people and we have a premium product that's a little bit more expensive than what a person can get on their own if they can get approved through traditional banks, right? So, it takes a lot of education around it and talking to the tenants and to being able to pull it off. But the demand's there. Like I had Jason, when he brought this to us, he said, "Hey guys, like I have this art form. I've been making a lot of money doing these deals, and you guys know how to do hundreds of deals a year. Will you partner on this with us?" We're in a mastermind group, got to know Jason at an intimate level. And I said, "Jason, like, are there really that many people that can drop 30 grand on a home that can't get a normal loan? Like, what are you talking about? No way." And he said, "Well, yeah, there are, there are." A year goes by. Finally, I'm like, "Okay, I'm sick of you bugging me. Let's go ahead and let's do a deal." And we had 2 people fighting over a property. One had 30 grand down. The other had 40 grand down. And we went with the one with 40,000 down before they moved in. And I was like, the light bulb went off, like, okay, there's something here.
What are those key factors that keep somebody, like you said, the initial reaction is someone won't have the down payment. That's why they're quote unquote a renter, right? But what are other factors that are preventing them from just going out and buying the home directly through a traditional lender as compared to going through the lease purchase model?
Yeah. So the marketplace as a whole, with the 3 kind of common buckets we have are people that are going through a divorce, people that are self-employed. Then the third is people that have had a hardship. So this was like one of our first 5 clients has a special needs kiddo. Special needs kiddo got sick. The medical bills piled up, got behind on the medical bills, dinged their credit. We crossed paths with them. They had actually paid off all their credit card bills that they got behind on, but their credit was still dinged. And their kiddo needed a specific school district that's very hard to find properties in. And they didn't have 8 years for their credit to rebound. We were so blessed to have a property in the school district, and we were able to go to them and say, "Hey, why don't you be a homeowner? The only thing you messed up was you didn't have a big enough nest egg to cover this one-time hardship. Yeah, well, let's have you be a homeowner so you don't have to rent. Get your kid in the school district they need." And when that happened, it just really has reinvigorated my investing career, because we were doing it for over 15 years, and it was kind of like, okay, things are going really well. Is this all there is? Like things are good. Like I found myself like seeking a higher purpose. And what's amazing about this is it allows us to have a massive impact for the community, to help people that have the need and that are underserved. And so in that case, it's a feel good story. And there's a lot of people like that. And I myself, I could have been one of our tenant buyers in my first 3 years of being self-employed.
Absolutely.
A bank's not going to want to touch us either. And, not all of them are feel-good stories. One of our clients he's still in the program, is a doctor that was in the middle of a divorce. And in Missouri, it's a marital waiver state. So like if you're married to someone, they have to waive their rights, sign a document that waives their rights on like a home purchase, or the wife would get half of it, right? So I like to think I'm a good negotiator, but there's no way I would be able to negotiate with a soon-to-be ex that, "Hey, let me buy this house with my new girlfriend to live in," while I'm in the middle of a contentious divorce, right? So he was thinking he has to rent, and we said, "Well, no, you can just get into our lease purchase program, and you're going to own it by contract, and then we'll build to it and get you into home ownership when the timing's right for you. But that, was a huge win for him too, because he didn't have to, blow a couple of years of rent in that situation.
And how did they find you? How are these people, these potential owners finding you? Are you marketing on a website that's like homes to buy through leases?
That's right. Yeah. We're marketing it. Good old fashioned bandit signs work, where we'll put them out all around the area. We have, because we've achieved economies of scale with it, we do have a bigger buyers list too. So there's times where, we'll have the property filled just through an email, right? And that, it's, what I dislike is I dislike when guys get on podcasts and say, hey, this is the best thing since sliced bread and it's so perfect and there's not challenges. Like, finding the tenants is one of the hustles. It just is. Now there's the demand for it, but it is work. Like, you have to put out the bandit signs, you have to put out the properties on different online sites, and for rent sites is one of the avenues we use too. And then when they call in, you do have to filter through and say, hey, well, no, this is lease purchase, not a traditional rent. And there's a lot of profit here. It's more profitable than being a traditional landlord, and there's a lot of work too, no doubt about it.
So walk me through, Jim. Once somebody signs up in the program, they give you a down payment, or you call it an option or something like that, right? That they're giving you up front to take on this kind of ownership by contract. What's the timeline that then they agree to then pay you off? Is it like, how many years do you give them before they have to get their own financing?
So I'll tell you what we do. And just so let me preface this with, this is like your choice as the investor. Like, you can do 6 months, you can do 3 years, you can do 20 years. It's like, this is a negotiable item. Our by default is we try and get people in for a 3-year lease purchase. And then if they can execute and cash us out of the deal, good. If they can't, then we turn it into an owner finance deal. And we like to give people the same deal that a normal buyer would get. If they make their payments every month, they can end up owning the house outright over the 30-year span.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
What percentage of people actually end up paying you off in 3 years?
Less than 3%. It's small.
Well, but that was the thing I was about to do before Russ just so rudely interrupted me, Jim, is, my background is in the mortgage business, and for years, these sort of strategies came around, and to be honest, it almost was kind of like, hey, we're helping people, cloaked in this hey, I really want to help people, so I'm doing this lease purchase. But really, they're taking advantage of somebody that probably was never qualified for a traditional loan, and saying, oh, well, it's been 2 years, you haven't, refinanced me, and I'm keeping your $30,000 or whatever option money. And I just never felt good about that. Like, that's just not a business plan I can get behind. So you're saying you're actually giving them the path to a 30-year loan without ever having a traditional bank.
Joey, thank you for bringing this up. Because had we not brought this up, I would have been frustrated looking back at this conversation. There is a predatory potential in this structure. There's no question about it. And if you're the professional and you have a tenant, and hey, I'm going to take $30,000 from you. You have 3 years to execute on the lease purchase deal. And if the deal falls apart and they back out, that $30,000 is not refundable. Okay, so it does become a situation where if they have a 0% chance of executing in 3 years, I personally don't think that's right. I think that's predatory, and that us as real estate investors, we should hold ourselves to a higher standard. There's no question about it. And it gets a little bit of a gray area, though, because if it's two adults entering into a legally binding agreement and it's like, hey, you're out, you have 30K, but I'm going to kick you out if you don't perform. And if they do have a chance to execute, like it could work out, like, I mean, from a legal perspective, that's okay, right? So what we wanted to do was we wanted to just take ourselves out of that gray area, and we wanted to give people the option, as long as they make their payments, we're not going to ever kick them out of the property. So that's something that we've innovated. I haven't heard of other people doing it. It's possible other people do it that way too, but you know, pigs get slaughtered, guys. And if you look at an amortization schedule, and you know, each deal that we do over 30 years is over $1 million of profit. Like, it's like, I'm okay if I leave a little bit of money on the table if I'm going to do right by somebody. And, you know, and I believe in the American dream of home ownership. We're here to serve and make money at the same time. And so we wanted to eliminate ourselves from that potential gray area with how we structured it.
Walk me through this, Jim. So let's say I do a 3-year lease purchase. I'm the person doing it. At the end of 3 years, I don't have the ability to get permanent financing for whatever reason, but I'm still making my payments on time. You say, okay, great. We'll just extend this out another 27 months, and you just keep making your payments. 5 years in, I'm moving out of, let's just say I'm in St. Louis where you guys are, and I'm moving to the great state of Alabama, right? Because I love real college football, and I'm just like, I'm going to go watch the Auburn Tigers play, right? Now, I've got 8 years of like paying in this as a quote unquote owner. Do I have the option to sell that property and recoup my 8 years of equity into the property? Is that an option? Or if I exit the property at the end of that time frame, am I exiting the deal and I have nothing?
So the program that we have, I mean, we would probably need about like a solid hour to like break this down into detail. So, you know, I know we're getting on time here in a little bit, but the answer is for our program is it depends on if they're in our first stage or our second stage. And like, there's different criteria on how someone fits. But when they get into our owner finance stage, we are leaving appreciation on the table at that point. We're giving them the same deal that a traditional lender gives a buyer. So let's say the home's worth $300,000. They're in our final owner financing stage. They have a 30-year amortization schedule at $300,000, and yeah, that functions as their property. Now, we do ask for first right of refusal if they end up wanting to move out at that point. We could buy them, and let's say the house is now worth $400,000. That's what it appraises at. If we want the property, we'll just repurchase it back from them. If we don't want the property at that point, then they can just sell it, and then they can get their that extra $100,000. Yeah. So that's a little bit of upside in our model that we've left on the table for people that get into our next phase. But, you know, I don't think appreciation, honestly, when I look at repairs and maintenance, I don't think appreciation outpaces what repairs and maintenance are on a given year. So we're really not, we're not being greedy. We have a good structure for the tenant too, but you know, there's give and take with that. Like, you can't be a partner with somebody and take on every angle, right? So that's one of the things we give up a little bit in the way we do it.
Yeah. Can you help me understand the mechanics of the money? So let's just talk about a typical property that you would buy, how then you would turn around and put it on a lease purchase and go through that process so that we can kind of follow the math a little bit.
Okay, so we would buy so Three Doors is the name of our acquisitions company. Three Doors would buy the property, and then HomeWays is the name of our lease purchase company that we developed. HomeWays finds the lease purchase tenant, puts them in there, collects the 5% down that we get. So then we have everything turnkey.
So Three Doors is going to buy a property at an average price of,
maybe 85 to 88 cents on the dollar. You know,
But can we just put a price to it, like a $200,000 house? Is that
okay? 200,000. Okay.
Yeah, and you're buying a
That's
house
what you're getting at. Like,
no, that's good. I just want to follow the math a little bit. So, Three Doors is going to look for a house that's 200,000, or that's worth 220, but they can buy for 200, right? You know, whatever 85 cents on the dollar is.
Yep.
And then they're going to hand over to HomeWays, who is your lease purchase company. They're out there finding those tenants, those people that want to be future homeowners.
Yep.
And they're going to say, okay, great. We got, they find a tenant, and then you guys are going to market that property that you bought for 200 that may be worth 240 to them to purchase at 240, or what is a typical, like using that example?
Yeah. Let's say the 240. I mean, it depends on the deal, right? But
right.
Let's say it's 240. So the tenant buyer gets in there, everything's passing occupancy. They're in there. It's pre-sold to them. They're agreeing to the repairs and maintenance, and then our real estate fund gets involved, and our real estate fund ultimately buys the property. Let's say for 220. It's about 92 cents on the dollar, so whatever that math is, but from the 240. So there's built-in equity on our real estate fund as well. And the real estate fund has, I don't know, 70 partners now in it or whatever the heck it is, but then that gets the turnkey asset. So that didn't take on any construction risk or anything like that. We do that within our other company. And so then the real estate fund then just cash flows the asset. And that's how the mechanism of how we're able to do the owner financing structure, because we have all the capital available from the real estate fund. It doesn't lock us into not being able to do more deals.
Yeah. So the original deal, I'm just want to follow the math and help Joey and those riding down the road who can't write it down like I am. You bought the property for 200. You sell it to the end buyer, to the lease purchase person at 240. They put down, you said, at a minimum 5%.
Yep.
So they're going to put down minimum $12,000 down on the property. So now they have a lease purchase to buy this at 240, but they've already paid down 12 grand. So their balance is 228 in that example. And then you're going to make a lease purchase payment based upon what a typical 30-year mortgage would be on the property at some interest rate.
That's right. Yep.
And so they're making payments. Is the lease payment is that reducing their balance, that 228 balance every time they make a payment, or is it almost like it's just interest only?
So in this case, they'd be on our initial stage.
Yeah.
So it would not be.
Okay.
But when they graduate out of the initial period, then it would be. They'd be getting principal reduction.
And the initial period lasts for how long?
Typically it's around 3 years.
Okay. So the first 3 years, every payment they're making, in essence, interest only. So at the end of 3 years, they still owe 228 on the property. All of that cash flow. Now, I know that you mentioned that you have a fund that's bought this whole thing. They're the ones collecting the money.
Yep.
But at the end of the day, at the end of 3 years, this person is going to try to go get a permanent mortgage to pay off you at 228. And so what you guys have been able to do is buy a property for 200, sell it for 240, pocket 100% of the cash flow for 3 years, right, as equity down, and then turn it and hand it over to the end buyer. The other 97% of the people, you're going to say, okay, I tell you what we'll do is we'll take this 228, I'm assuming 228, and give you a 30-year note on it, which will be a principal and interest payment, which means their lease payment's going to go up from where it is today. Is that correct?
It depends.
Okay.
No, dude, I get why people listen to the show, man. You guys are sharp.
Well, no, I'm looking.
Yeah, no.
Understand myself.
Yeah, it depends, but and we will.
You don't even know. Like, he's literally got his shoes off, counting on his toes.
He's counting on his toes. I love it. Sometimes if we're in a situation like a cash flow situation, we will go up to 40 years.
Yeah. Okay.
If it's a bigger win for the tenant, or we call them tenant buyers, but
sure,
if it's a bigger win for the tenant buyer to keep that monthly the same, and we have to go out to 40 years, we will do that. But the model's been fantastic. It's been great. And I mean, lease purchase deals, okay. So for example, I have two. So what properties work in this model? We don't really like to do them with multis, like duplexes or four families. You can do them, but it's just a little bit more difficult to find that right person that wants to also be a landlord. And I have two families that I had $20,000 of repairs and maintenance for last year. And out of the 140 houses we have in our previous fund, we only had about $50,000 of repairs and maintenance. So 2 versus 150, it's it's about half of what the repairs and maintenance were, right? So
I love it. I'm just looking at this
deal structure can change your life with the passive income it can generate.
Yeah, I'm looking at it from an investor perspective. Man, I see where the money's at. I see how this is an opportunity where either one, if I was trying to do it on my own, or if I was trying to invest in a fund that was doing it, I just want to be able to follow the cash. And I'm like, oh wow, there's lots of different money opportunities in this deal. Ultimately, what's the biggest risk in here? How do I lose 100% of my money in a deal like this? Is that even possible?
I don't think it's possible to lose 100%. It's really more of a question of how much money you're going to make. You do have a landlord risk. If they come in and they just completely demolish the property. So all of the normal landlord risk does apply to these deals. It's just less because if someone puts 15 grand down on a home, they're acting as a homeowner. Homeowners take bad care. Some homeowners take bad care of their properties, no question about it. But most don't. Like no one washes a car rental, but they wash their own cars, right? It's the same premise here. And having skin in the game like that from people that really appreciate the opportunity because other people haven't, no one else has given them that shot. It de-risks it substantially. So when we have tenant turnover, that in the normal landlording business, that ends up eating returns. And in our model, because of the down payment, turnover most of the time increases returns a little bit. But there's been a few deals we've done where we've broken even on turnover. But, anytime in real estate, when you extend the exit strategy, it dramatically lowers risk. Like when we were doing the 240 flips at the same time back in 2016, 2017, whatever that was, everything had to go perfect. Mm-hmm. But, you look at the average price point in 1990 was about $92,000. Fast forward to today, it's, I don't know if you get, it's like $300,000 now or something like that, right around there on a national level. So, if I bought a $90,000 house in 1990 for 105, I made a mistake, but my exit strategy is 30 years down the road. You can make mistakes and still do really well on it in the structure.
Such a great process that you guys have built. And I love the redeeming aspect of it that, there are people that are in need of dignity at certain stages of life. And as you mentioned, I think so humbly, we all could be there, right? It's not like those people. It's we are the people that could be in the same need that you're able to serve. And man, I'm just grateful you're willing to come on today, Jim, and share the strategy with our audience. It's not one that we've covered, especially not in the same model. For those that want to connect with you outside of the show, what would you have them go to?
Yeah, absolutely. So passivewealthshow.com would be a good place. And if for those of you that are more on the passive side, you like the strategy, you don't want to do any of the work, maybe you have some capital. The fund I was just talking about is closed out to new investors, but we have another one that's in the process of opening up so we can have those conversations. Also, if you are a landlord that owns properties and want to know if maybe a lease purchase would be a good structure for you, we can help you. The company HomeWays can help you place a tenant and everything like that too. So we can, if you want to do your own deals, we can help you in the lease purchase world, or if you want to kind of do your deals through a team, we can help you do both. So passivewealthshow.com, and I think there's like a Calendly thing or something like that where you can talk to us. I'm not the tech guy, as you know. So yeah. So just get a hold of us. We're happy to build a relationship. We're we're a little bit old school. That's how we've done things. It's not, like just doing what we say we're going to do and building rapport and trust. And I think that's a big part of it. Right. So, we're willing to have a conversation with you, help you any way we can. And I mean, my schedule gets pretty tight at times, but if I can help you, I'd love to. I just have to squeeze you in, but yeah.
Awesome. Well, Jim, thanks again for being on. And Tribe, thank you for listening. I hope that this strategy is one that is new to you and it's something that you got value from today. If so, do us the favor of sharing it with a friend, somebody else who's on the same path or needs to be on the same path to find financial freedom as fast as possible. Thanks as always, and we'll catch you on the next episode.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.